Welcome to Personal Pension Radio Podcast, where you get unconventional insights into retirement and lifestyle design that actually work. You don't have to settle for the same tired Wall Street advice. Break away from the herd and learn how to achieve the retirement lifestyle of your dreams. And now, here's your host, the income engineer, Kraig Strom.
That's my cue. Yes, I am Kraig Strom, the income engineer. You can find me online. Best place to find me is LinkedIn, linkedin.com, Kraig with a K, Strom. Look me up there on LinkedIn. Love to connect. I am broadcasting from the Personal Pension Radio Workshop Studio here in Southern California. If you haven't already been there, check out personalpensionradio.com. That is where we post the show links. We post episode show notes and things like that. If you're missing anything or if you want to reference anything from this show, please don't hesitate. Go there or contact me on LinkedIn. Contact me through personalpensionradio.com. Now, what this show is about, always an important thing to remember, this show is about optimizing retirement income. That is critical. Optimizing retirement income, that terminology, that phrase, listen for it, because in the financial world, you don't hear it as often as you would hope, or I would hope you would hear it. Now, I was educated by the Wall Street financial advisory machine. And I say that fondly, if you will. The Wall Street advisory machine is the education system ultimately funded by Wall Street. And Wall Street is gigantic when it comes to advertising the primary message, which is accumulation. Accumulation is the answer to everything. You think about it, I've said it on this show before. If you get a flat tire, it's because you didn't save enough money. If you want to go to college, send your kid to college, you got to save a lot of money. If you want to retire, you've got to invest. The answer is always invest and always save more money. Unfortunately, that is not the solution. It's not the answer to maximum retirement income. Maximum retirement income does not happen with a product. It doesn't happen with life insurance or investments or 401ks or annuities or real estate or Roth IRAs. None of these things by themselves will actually help you achieve an optimized retirement income. It's not until you actually integrate all of these things together in the appropriate balance. An integrated approach is the only way that you can achieve maximum retirement income. So this show is meant to give you hope for retirement. I will continually challenge you. Go and ask your financial advisor for your retirement income number. You hear these commercials on TV and on the radio. What's your number? How big's your retirement number? People walking around with those stupid signs that have a $500,000 for their retirement number, and you got somebody else who's walking around with $250,000 and $1 million. So what? Go ask the most important question. How much income can I expect to have from all of this accumulation, all of this savings that you've been doing? Ask for your income number. This show is meant to give you hope for retirement, to turn that light on at the end of the retirement tunnel, but you have to be willing to ask that hard question. Ask, how much income can I have? And I'll give you an example. This is true stories. I always share these. These are people that have actually asked the question, and I'm going to use $1 million because it's just easy. That, hey, what's my retirement income going to be, Mr. or Mrs. Financial Advisor? Well, based on our current projected growth rates, you're going to have $1 million when you retire. And with $1 million, you can expect to take 4% from your $1 million, so you could expect to start your retirement with a $40,000 withdrawal from your retirement assets. $40,000 from your $1 million asset, right? Wait a minute. 4%? That's ridiculous. That doesn't sound plausible, but that is the answer that Wall Street's been giving for 30 years. 4%. What if you're one of those poor folk walking around the park on the TV commercial with only $500,000 in your retirement account when you get ready to retire? Well, at 4%, enjoy your $20,000 a year retirement, right? And that's before taxes. Heaven forbid if you have $1 million 401k and you're going to get $40,000 and then they're going to take taxes out of that, right? So this show is meant to give you hope for retirement, but you've got to be willing to look past this conventional Wall Street wisdom. It's just not working for people. Thanks to the death of private pensions, the devaluation of Social Security benefits, and other undeniable factors like inflation, increasing taxes, we are in a retirement income crisis. No doubt about it, a retirement income crisis. This show is focused on helping you pack your retirement bags correctly for both sides of the retirement journal. You've got retirement journal, the retirement journey. See if I can get my tongue on straight. You've got to have your accumulation strategy tied and linked together and integrated together for your distribution strategy to work. And I want to help you build and protect your wealth, your lifestyle today and into the next generation. That's what I'm all about. So before I forget, quick disclosure, I am not an attorney. I am not a certified public accountant. I am a certified financial planning professional. That's what I do. I've worked really hard to be not only a CFP, but a chartered financial consultant and a variety of other numbers and letters and qualifications and years of experience. But with all that, it still doesn't mean that you should act on things that you hear on this show as if you're getting advice for you personally. This show is meant to give you information, meant to just prompt you and encourage you to take action. But please don't act on things that you hear on my show as if you've received personal advice. And especially, dear me, please do not act on things that you hear from financial entertainers, people who are not licensed, who have no regulatory oversight to watch out for your best interest. Please don't take advice from those folks. Please meet with a qualified financial advisor. I would love that advisor to be me, but if you're going to meet with someone, I would encourage you to look for someone who's a certified financial planner, for example. Now, let's jump right in. Section 1, the section that I love to call Watch Your Step. Last week, I reminded you to build your house correctly. Don't let people try and convince you to invest, or to build your financial house incorrectly. Start with protection first. Build a strong fence, a strong wall, a moat, whatever you want to call it. Build a moat of protection around your financial house first. All of your insurances, your car insurance, your home insurance, your life insurance, your umbrella coverage, all of those things, including disability paycheck insurance, all of those things, protect. Then build a strong foundation. That's liquidity. That's cash on hand. That's money available for opportunities and emergencies. Then, only then, do you put up the walls. Do you start investing? And you cap it off with a great income plan so you can enjoy an awesome lifestyle, right? So that's what I covered last week on episode number 119. If you want to go back and listen to the full episode to get the details, please do. Go back and check that out. Now, this week, I have something unusual because it didn't surprise me, but I guess it did a little bit. I cannot remember where I heard this. I think it was on a random television channel that I was watching late at night, that there was actually an advertisement for pet financing. Pet, like buy a dog or buy a cat, finance the purchase. Yes, pet financing. And now, it again caught me off guard initially, but I have to say, Here in California, the land of gourmet dogs and, superstar models and people carrying around chihuahuas in their little bags and purses. And it didn't surprise me at all because gourmet dogs are all the rage here in California. I'm sure it is wherever you are as also. But I was just amazed that there was a pet financing company that clearly was making enough money to advertise on television. It blew me away. No way. So I looked it up and I grabbed the first one that popped up, that there is a company called wagslending.com, WAGS lending.com, affordable, listen to this, affordable leasing for pet lovers. Leasing. You can lease a dog or lease a cat. Oh, I cannot, but it just makes me smile. So here's what I want. The reason I'm sharing this is because I am all about efficiency. In my personal financial life, I always look for the efficient way to buy something or the efficient way to spend money. I mean, there's always some way to find an efficiency when you're talking about your finances, whether it's in your investment accounts, whether it's in your life insurance, whether it's in your car purchase, whatever it might be, there's always a way to find an efficiency. And the first thing that popped into my head when I heard pet financing was, oh man, what a waste of money. What a waste of money. Whatever the interest rate might be on pet financing, it's too high. Because as much as I love my dog has not just a depreciation like an automobile. An automobile definitely has a depreciation where it will eventually reach zero value, right? It's going to take a long time for most cars to reach zero depreciated value. However, with a dog, and I'm a dog person, so I'm going to use dogs. If you have cats, great. If you have a dog, you have to be realistic. Your dog has a known zero depreciation day. There is a known point in the future that you may not know exactly what year it is, but if you've got yourself a Labrador Retriever, you're not going to see that dog go much past 10 years, right? You know that dog has a finite lifespan. And here we are with an affordable leasing program for pet lovers. That's the first thought that popped into my head was, oh my gosh, that has to be such a waste of money. Gotta be kidding me. So I went to this website, wagslending.com, and sure enough, they had a calculator there. So they would tell you how much your lease payment was for your animal purchase. Well, I put in $2,500 for the cost of the dog, the hypothetical dog, and I'll tell you where the hypothetical dog came from in just a moment. But the hypothetical purchase number, $2,500, financed for 2 years. All right, so they offer a 2-year leasing program, and it was $147 a month. $147 a month works out to $3,527. Remember, it's a $2,500 dog, and by the end of 2 years under this lending program for pets, you paid $1,000 in leasing fees. They say it's not a finance charge. You're paying depreciation on the dog in addition to rental costs. So that's leasing. Leasing in this case is the cost of the depreciation on the animal. In this case, it's an animal, the thing you're purchasing, not a car, and the rental of said animal. So $147 a month times 24 months is $3,527 for a $2,500 dog. Now, I wanted to check and see what the interest rate is. Now, this company says it's a leasing rate. It's not an interest rate. Well, it is an interest rate. Come on, let's be real. So I'm just curious. So I plug it in to my trusty HP 10B calculator and check the interest rate. And it was such a big number. I said, I must have done something wrong. Then, if you listen to the last episode, I had to give someone a thank you and credit for correcting me on bad math from 2 episodes ago. So I thought, I better double check myself because that number seems really high. So I actually did just that. I went to another computer program on my laptop and ran the number, and the interest rate for a $147 a month payment on a 24-month cycle on a $2,500 dog, it was a 39% interest rate. 39% interest rate is what it actually penciled out to. Unbelievable, right? Now, again, this came up on a television commercial. So somebody had the money to pay for a TV commercial for financing pet purchases. Unreal. I could not believe that. Now, let me share just personally why this is something that's very close to my heart. I love animals. I love dogs especially, but I have rescued dogs, cats, all different. I rescued an owl that had been hit by a car in the middle of an intersection in a busy city near where I live. I've literally rescued all kinds of creatures, great and small. I love them. Now, with that said, I also hate the idea that there are dog pounds, animal shelters all over this country that are just jammed full of dogs and cats and birds and critters that cannot get a home because someone is out there paying $2,500 for a gourmet dog instead of going to the pound and rescuing a dog from the pound. Like, really, why would you go? Okay, I'm getting on the soapbox here. I have a passion for animals. I love dogs. I love cats. I love all creatures, great and small. It just kills me to think that not only are people out there buying a $2,500 gourmet dog or cat, we actually had at one point a pet store selling a certain type of cat for as much as $20,000 for a cat. It just boggles my mind that people would do that when we have animal shelters all over the country just busting at the gills busting at the seams with animals looking for a great home. And I've said this for years, though. I mean, like I said, that pets that are genetically diverse have fewer health problems, right? So mutts and pound puppies and things like that, they just have fewer health problems. And like I said, I've looked at it. I've researched it. Scientific American, the Humane Society, PetMD.com, a variety of places that actually verify that purebred dogs and cats tend to have a host of genetic health problems that face scores of different breeds today. Higher risks of cancers and tumors and eye problems and heart disease and all these things that purebreds have. So not only do we actually have people out there financing a $2,500 dog, but you run the risk of also getting a dog like my friend who purchased a $2,500 teacup Maltese, from a breeder that they actually had to fly the dog in to California from where they purchased this dog. And such a cute little dog she was. She's just such an adorable little dog. But by the time she was a year old, she had developed a genetic defect in her spine, a spinal deformity that was traced back to and assumed to be part of a genetic deformity that paralyzed her from the rear hips back for life. Paralyzed. Done. She had to be fitted for a tiny little wheelchair. And she really did well. She ran around and had a good little life, but she basically got stuck in a wheelchair. Now, today, as I'm thinking about this, I'm trying to think of what makes me more mad. The idea that people would spend over $1,000 in interest fees over 2 years of 39% interest to finance a dog, right? Or the fact that when someone buys the $2,500 dog, there's a bunch of pets at the animal shelter and Humane Society that could use a home, right? Which one bugs me the most? Well, what I did as I was thinking about this, I actually went to petfinder.com and I looked for a Maltese. And sure enough, within 50 miles of me, this Maltese popped up. His name is Casper, and he's a Havanese and a Maltese mix. He's pure white, just a tiny little guy, maybe a year old or less, just the cutest little thing, and you could adopt him for less than $300. $300. You get yourself a beautiful little Maltese that needs a home instead of spending $2,500 on a dog that you just don't know whether they're going to have genetic problems or not. There you go. So I'm going to get off my Humane Society soapbox, but please, if you're in the market for a dog, go adopt one, go rescue a dog, save one, right? They're out there. Trust me, go to petfinder.com. You can find virtually any gourmet dog that your heart may desire. They're at the pound somewhere hoping that you'll take a look. Now, segment 2, this listener question came in, and this person says this: Kraig, I've been looking for a financial advisor that I can work with locally. I have 2 finalists with different credentials. One is a certified financial planner, a CFP, and the other is a CLU, but I don't know what CLU means. Now, let me continue. I'll cover that in a second. The CFP has 12 years experience and says that he follows the fiduciary standard. The CLU has over 30 years of experience. What does fiduciary standard mean, and should I choose that over experience? That's a good question. So let me go back and make sure you know what a CLU is. A CLU is a chartered life underwriter. Now, CLU is a professional designation in the financial services world that predates certified financial planner. It predates virtually any financial designation you can think of today. CLU was the pinnacle of financial designations in many ways 20, 30 plus years ago. And it still is something that amongst professionals like myself, accountants and attorneys, the CLU designation is very well respected. It did have its origins in the life insurance world, life underwriter, as you can hear in the CLU title. It had its origins in the life insurance world because, truth be told, 40 years ago, there was no 401k. There was no college 529 accounts. There was the life insurance industry and the banking industry. Those are the 2 big places, right? So the life insurance industry was a big part of retirement planning and college savings and such. So the CLU is a very good designation. It usually means that this person has a great deal of experience. And sure enough, 30 years of experience. Now, what does the fiduciary standard mean? The fiduciary standard in a nutshell says that a financial advisor is required to put the client's needs ahead of the advisor's needs. Client first, and it's required, right? Now, when I hear this, every single time I hear this, I say, well, duh, of course. Good business puts the client's needs first. That just makes good business sense, right? Well, no, of course we need the government to give us a law that tells us that we should put our clients' needs first. Yes, there's a bunch of bad apples out there that put their own self-serving needs ahead of their clients. There are bad apples in every industry, from the financial industry to the accounting industry to the legal industry to the sales industries of all shapes and sizes. That's a fact. It's never going to change. But this fiduciary standard, I still say it was really driven by the financial planning community driving this kind of regulation, because if this law passes and is put into place, the only people that can really operate in that fiduciary standard are those that are in the financial planning community, like myself, that have all the right letters and numbers next to their names. There's a lot of people out there, like this CLU, for example, may not have the appropriate letters and designations and licenses to operate easily under the fiduciary standard. Okay? That doesn't mean that the CLU doesn't operate under the fiduciary standard, because they could be a lot like me. Even before I was a certified financial planner, I operated under a fiduciary standard set by myself. I call it my own take on the golden rule. My rule is, as long as I take care of my client's wallet first, my wallet will be fine. And that's the way it's worked for 18, 19 years. It's just, as long as I do the right thing for the client, my position will be fine. And that's my fiduciary standard, even before I was in the financial planning community as a certified financial planner professional. So I would say this about your choice. I would look for a very specific bias. Look for a very specific bias, and that bias is this. Make sure that they actually are in it for you. Make sure that they have a bias in favor of your best outcome. That's what you've got to look for. Now, can you find that easily? Do you know how to find it? You've got to ask questions. You've got to have a good, open communication with whoever you're going to have as your financial advisor. That's something that you've got to do personally. You need to have a very frank and open conversation with your financial advisory candidates. I would ask questions, as you've heard me say. I would ask questions about, all right, great. What's my retirement income plan? What are we going to do to make sure that I don't outlive my income? What are we going to make sure, how are we going to make sure that my castle is protected? And have them respond to you. Listen to those answers, right? Because here's the thing. If you look at the fiduciary rule, right, this is the way the industry approaches it, right? The industry approaches it this way. Let me use an example. This is actually a recent survey that was actually done by a financial firm, the largest 401k advisor in the nation, a company called Financial Engines. And they did this survey, and the results of the survey, I'll say this, and then I'll give you my opinion on what I think the problem with the survey is. The results of the survey were this. 93% of Americans want financial advisors to provide retirement advice, to put their client's best interest first, and be legally required to do so. Well, okay, what was the question that got a 93% response? Do you think the question was something like, hey, Mr. and Mrs. America, if you were going to work with a financial advisor, do you want to make sure that the financial advisor is legally required to put your best interest first before their own? Yes. Well, of course. Who's going to say no to that? Apparently 7% said no or didn't respond, right? It's a very self-serving survey from the folks at Financial Engines, because they're in that fiduciary standard qualified section. Doesn't it make sense that they would conduct a survey with the question that would give them a 93% of Americans want advisors who provide fiduciary best standards, right? Of course you're going to get that. But therein, right there, that just shines, for me, it shines a light on the bias within the industry, right? The bias with the industry is that this company is the biggest 401k advisor. Well, how do those advisors get paid? Well, they get paid fees based on the 401k balance. They get paid a fee based on the 401k balance, right? So do you think they might be biased in favor of fiduciary standard, which says, oh, we only get paid fees on your money. We don't charge commissions, or we don't get paid commissions? Well, they have a bias in favor of more money under management equals more fees, right? That's their bias. So what if that's not exactly right for you as the 401k participant? Well, that's too bad, because that's the standard that they operate under. Doesn't that automatically mean that maybe they have a fiduciary conflict? Nope, everything's going to be a square peg in a round hole no matter what. For that, so you get a 93% of Americans, right? It's just it's a silly survey, but it's very self-serving for the industry that is purporting, to put this information out there, right? The fiduciary rule is a good thing, but you do not need to choose your financial advisor based on the fiduciary rule. You do need to choose a financial advisor that has that very important bias. They're going to do things in favor of you and what's best for you first, right? And you got to look at this. A 30-year CLU, somebody that's been in the business for 30 years, they clearly are doing something right to be in the business 30 years and to have that kind of credential. But that doesn't mean that you don't ask good questions. You still have to ask good questions, okay? Now, I'll finish with this. In the financial world, you'll have a variety of different people that are spouting off about, I'm a fee-only advisor. I only take a percentage of your assets as an investment manager. I get paid a commission. Well, which one is right? I propose this, or I would suggest this. A fee-based model is one that allows a financial advisor to get paid a fee, charge a fee to the client if it's appropriate, or get paid a commission on a product like life insurance or an annuity if that fits well for the client. They can also charge a percentage of investments under management if that's appropriate for the client. A fee-based model is one that you usually see with a certified financial planner or even a chartered life underwriter, someone who's been around the business for 30 years. You might see that where they have the ability to offer a variety of different ways for them, the advisor, to be compensated, but they have the freedom to choose which one is best, to be able to choose the one that's right for you and not be pigeonholed into fee only or commission only or fee percentage of management, assets under management only, right? Look for somebody that has that option to be able to operate under a fee-based model, and you have a better chance of finding someone who's going to be able to give you a wide spectrum of advice and not just be narrowed into one thing, all right? So that'll wrap it up today. Please remember, take action. Get out there. The future belongs to those who take action. Last week, I talked about disability income protection. Insure your paycheck. Folks, it's so critical that you get out there and follow the right steps in building that financial castle. I'm Kraig Strom. I'm the income engineer. I'm here to help. Thank you so much for all the questions. Keep them coming. We'll talk to you again real soon.
Thank you for listening to the Personal Pension Radio podcast. We took notes for you, so if you missed any part of the show, you can find a full transcript of each episode at personalpensionradio.com. Be sure to download your free retirement income crisis report at personalpensionradio.com. While you're at it, we would appreciate some iTunes love. Please leave us a fantastic rating on iTunes by going to personalpensionradio.com/iTunes. Thanks again for listening. Now for the disclosure. Information presented is for educational purposes only and is not intended for solicitation, sale or purchase of any security or financial product. Be sure to first consult with a qualified financial advisor and your tax professional before implementing any strategy discussed here. The term personal pension refers to a marketing name designed to educate future retirees and retirees about the economic principles behind creating their own pension-like income. The term personal pension is not intended to be confused with a defined benefit pension plan offered by an employer or by a government entity.